Professional fund managers spend their entire careers trying to beat the stock market. They have research teams, advanced models, and access to information most individual investors never see. The vast majority of them still don't beat a simple, low-cost index fund over the long run. Here's the part that makes this more than just an interesting statistic. There's an actual mathematical proof for why this isn't surprising at all. Not a pattern researchers notice in the data. A proof, the kind that doesn't depend on which decade you're looking at. By the end of this video, you'll understand exactly how that proof works, what decades of real fund performance data confirm about it, and the precise takeaway for how you should think about your own investing decisions. Part 1. Active versus passive investing. Explained. Active management means a fund manager is actively choosing which stocks to buy, sell, and hold, attempting to identify undervalued companies or time market movements in order to outperform a benchmark index. This requires research staff, trading activity, and judgment calls, all of which cost money, reflected in higher fees charged to investors in the fund. Passive management, most commonly through an index fund, means simply holding all, or a representative sample of all, the stocks in a given market index in the same proportions as the index itself. No stock picking, no market timing, no judgment calls about which companies will outperform. Because there's no active research or trading decision-making required, costs are dramatically lower. The entire debate between these two approaches usually gets framed as a question of skill. Are active managers, on average, skilled enough to justify their higher fees by beating the market? What Sharpe's work showed is that this framing misses something more fundamental. The answer doesn't actually depend on skill at all. Part 2. The mathematical proof. In 1991, economist William Sharpe, a Nobel laureate and the creator of widely used tools like the Sharpe ratio and the capital asset pricing model, published a short paper titled The Arithmetic of Active Management. It's one of the more elegant proofs in finance, and it doesn't rely on historical data at all. It's true by definition, based purely on how markets are structured. Here's the core logic. The total stock market is, by definition, the sum of every investor's holdings combined. That means the average return earned by all investors, weighted by how much money they have invested, has to equal the market's overall return. There's no other dollar of return floating around anywhere else. It's a closed system. Now split all investors into two groups: passive investors, who simply hold the market through index funds, and active investors who are all trying to outperform it. Since passive investors by definition earn the market return, and the combined average of everyone, active and passive together, also has to equal the market return, the active investors as a group must also average out to exactly the market return before costs. Every dollar one active investor gains above the market average has to be exactly offset by another active investor's dollar lost below it. It's a closed, zero-sum competition among active managers before fees enter the picture. This is the part that flips the entire debate. Once you add in costs and active management charges meaningfully higher fees than passive index funds to pay for the research staff and trading activity from Part 1, the average active dollar must underperform the average passive dollar, by definition, exactly equal to that fee gap. Not as an opinion about manager skill, as an unavoidable mathematical consequence of the system the two groups are competing inside of. Part 3. What the real-world data confirms. Sharpe's proof predicts what should happen mathematically. The real-world data confirms it actually does happen, consistently, year after year. S&P Dow Jones Indices publishes a regular report called the SPIVA Scorecard. S&P indices versus active, comparing actively managed fund performance against their relevant benchmark indices. The consistent finding, repeated across nearly every report cycle for years, the large majority of actively managed funds, frequently somewhere around 80% or more depending on the category and time period measured, underperform their benchmark index over 10 to 15-year periods. This isn't one bad decade for active management. It's the expected outcome the math from Part 2 predicts, showing up reliably in the actual fund industry period after period. To make this concrete with real numbers, Imagine two investors, each starting with $100,000, both earning the market's average annual return before fees over 30 years. One pays a typical active fund fee around 1% a year. The other pays a typical broad index fund fee closer to 0.05% a year. That roughly 1 percentage point fee gap compounded over 30 years can easily account for a difference of well over $100,000 in final portfolio value. Not because of any difference in stock picking skill, but purely from the fee drag working against the active investor every single year. Part 4. Why some managers do still outperform. This isn't an argument that no individual manager ever beats the market. By definition, in a zero-sum competition among active managers, roughly half outperform the active average in any given period, and some outperform by a lot. The actual hard problem is identifying in advance which manager will be the one who outperforms going forward. And this is where another consistent finding from fund research becomes relevant. Persistence studies, including data tracked within the SPIVA reports, repeatedly show that funds which outperformed in one period are not meaningfully more likely than chance to outperform again in the next period. A fund's top quartile ranking in one 5-year stretch is a weak predictor, at best, of top quartile ranking in the next 5-year stretch. This connects to a separate important data quality issue, survivorship bias. Funds that perform poorly tend to get quietly closed or merged into other funds over time, and they typically disappear from the historical databases used to calculate average active fund performance. This means published long-term active fund averages are often skewed upward since the worst performers have already been filtered out of the sample by the time the data gets reported, meaning the real performance gap against passive investing for someone who picked an active fund at random years ago was likely even worse than the surviving fund averages suggest. Part 5. The exact takeaway for your own investing. Given both the math and the data, here's the practical framework. For the large majority of individual investors, a low-cost, broad index fund remains the highest probability path to capturing the market's actual return, precisely because it sidesteps the zero-sum competition described in Part 2 entirely. You're not trying to be in the winning half of active managers. You're simply collecting the market average, which the math guarantees before any fee drag. If you do choose to use actively managed funds, evaluate them over the longest track record available, ideally 15 years or more. Measured net of all fees, not gross performance numbers that ignore what's actually deducted from your return. Short 3 to 5 year outperformance, the kind most often used in fund marketing, is exactly the noisy, low persistence signal Part 4 covers, not a reliable basis for a decade-long bet. Be specifically skeptical of recent outperformance used as a selling point, given what persistence research shows about how rarely top performance repeats. A fund's last 5 great years tell you very little about its next 5. Part 6. What this doesn't mean. This isn't an argument that all active management in every context is worthless. Some less efficient, less closely tracked markets, certain smaller international markets, for instance, may offer more genuine opportunity for skilled active research to find an edge than the heavily analyzed US large cap market does. It's also not an argument against working with a financial advisor in general. A good advisor often provides real value through tax planning, behavioral coaching during market downturns, and overall financial structuring, separate entirely from the specific question of whether they can outpick the broad market through individual stock selection. The point is narrower and more specific. The claim, this fund manager can reliably beat the market through stock picking skill, is the specific claim that both the math and the data consistently struggle to support. The reason most professional fund managers don't beat the market isn't a lack of talent or effort. It's that beating the market, as a group, is mathematically close to impossible before fees, and mathematically guaranteed to be a losing proposition on average once fees are added, exactly as Sharpe's proof predicts and decades of SPIVA data confirm. So here's the one action. If any part of your current investments is in actively managed funds, pull up the actual net of fee performance over the longest period available and compare it honestly against a comparable low-cost index fund over the same stretch, not the marketing page, the real number. If this gave you an actual mathematical reason for advice you'd already heard 100 times, subscribe. Next video breaks down exactly how to evaluate a fund's expense ratio and fees, step by step, before you invest a single dollar.